If you tuned in last month, you saw me talk about market cycles, or the way valuations can fluctuate over time. This is in regard to earnings or sales. Well, the same could be said for economic cycles, and at the end of the day, all these companies exist in the economy. So let's look at how those economic cycles evolve from growth to contraction.
Get down, baby!
Moving on, with economic cycles, we can sort of throw valuation out the window. There's some aspect to that in credit, but let's not get derailed there. With economic cycles, we're largely talking about expansions and recessions. A recession is when GDP contracts for consecutive quarters. Next, obvious question, how does this happen? Well, let's think about it this way. Growth is created by a function of capital, labor, and consumption. A company builds a factory, capital, to build widgets through labor, and its employees use the fruits of their labor to consume more widgets. It's a beautiful feedback loop. The lubricant for all this is liquidity, how much money is available, and the energy behind that is credit. As credit expands, the capital base grows, more labor is needed, and consumers can borrow to buy more things that they want. Swipe that credit card. However, there's a point in which this credit has been overextended, and we begin to see a reversal of the positive loop into a negative loop. Businesses make less money, jobs are lost, and consumers tighten their belts. Without getting into all the nuance here, the next question is, how do we apply this framework to determining the stage of the economic cycle or potential turning points? That's actually fairly simple, and we have intuitive data points for each factor. Let's take credit, for example. Well, a large portion of credit is coming from banks. These banks make their dough by borrowing short-term and lending long-term. So all these folks talking about yield curve inversion as a recession indicator are all just trying to get a pulse on bank lending. If short-term rates, say a 30-day T-bill, are higher than long-term rates, say a 10-year treasury, then it's only rational for all those bankers out there to start reining in lending, as it has become less profitable and thus more risky for them to do so. This also says something for growth expectations in the near term. Rates are driven by inflation and growth. And if rates for short maturities are higher than long maturities, so short end, long end, then something's happening in the middle, indicating a slowdown. For credit, we can also look at how yields on corporate bonds compare to risk-free rates as a measure for risk appetite, but the yield curve as a signal has never failed. Right now, we're hovering around 0.3%, so very flat on the 10-year minus 3 month. After getting as high as 3.7% in 2009, this is a typical late cycle signal. After credit, we next look towards the labor market. If jobs growth stalls and unemployment climbs, those disenfranchised workers are likely to pull back on spending, not to mention it says something about how companies are formulating their capital plans. This, again, is fairly simple. We track the unemployment rate, or perhaps an even better measure, continuing unemployment claims. We got to as low as 1.65 million if we look at this measure last year, and we've risen to 1.77 million, so up a bit. It's great that we've tapped multi-decade lows on the unemployment rolls, but this unfortunately also points to a late cycle environment. You're getting a theme here. Finally, we round it out with some quick hits on capital and consumption. For capital, we can look to activity readings on manufacturing via the US PMI. This is a survey of purchasing managers that gives us insight into current conditions, inventories, orders, and future expectations. It provides a solid read on whether or not that capital base is set to expand. A PMI above 50 is expansionary, but declines above 50 show slowing growth. And also, for consumption, we can simply use retail sales. This is a monthly report which provides data on whether or not those laborers are increasing their consumption at a similar rate. What are we all buying, guys? Any slowdown in retail sales would be indicative of a cautious consumer. We can add this to consumer confidence as a forward-looking measure. This should serve as your weather vane moving forward, this framework, but we also want you to start thinking in this way well into the future, especially when it comes to risk appetite. From that early to mid stage of the cycle, you ramp up your risk. Call it from 8 to 5% on unemployment, for instance. And once you get deep into the cycle, that is when you focus on quality, value, and dividend yield in your equities to phase some risk out of your portfolio. Of course, this isn't an end-all be-all, a panacea for market timing, nor do we recommend trying to time the market. We just simply wanted to give you an idea of how investors can react to economic and market cycles in order to tactically manage risk. A late cycle environment may mean lower expected returns for equities, but equities should still outperform bonds in the long run. This sort of analysis is what we do here at Henssler, and I hope this has been informative. This has been Jacob Keene, research analyst at Henssler Financial, signing off on a moderately casual Finance Friday. Thank you.